Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello, my dear students. Welcome to the discussion on IBS, some interesting case studies which are specifically related to the context of direct and indirect taxes is what I'm going to discuss with you. As you all know that this is Shivateja, faculty from IndigoLearn with respect to direct and indirect taxes. So we are going to discuss the interesting content, interesting elements in the case studies, particularly from the direct and indirect taxes perspective. So those related points in that particular case studies is what I'm going to discuss with you. So I'm sure we all are ready and set for the discussion, my dear friends. Good, wonderful. So without any delay, let's proceed for the discussion and discuss some very, very interesting case studies, guys. Come on, let me start. Good. Friends, please understand that this particular paper and this particular subject called Integrated Business Solution is a very, very interesting paper for a simple fact and reason that whatever subjects you learn, all of them get combined together into one particular platform called IBS, and questions come from multiple angles. Be it direct tax, indirect taxes, financial reporting, all subjects combined together, questions keep coming. And when I say direct and indirect taxes, the concept is very clear that the content what you're learning in CA final with respect to paper 4 and paper 5, direct and indirect taxes, the same elements are those which are repeating even in IBS as well. So during the course of discussion of whatever point comes in that particular case study, we are not just going to talk only about that particular point, but we'll also discuss the concept revolving in and around that particular point. Are we clear, everybody? So without any delay, let's start the discussion, my dear friends. Come on, please see that. So let me talk about this interesting case study one. You would have heard about this in financial reporting and other case study analysis as well, but let me talk purely from a taxation perspective. Caber Cabs, which is better known as the name Caber, is an Indian startup company which provides online cab services. Very good. It was founded in so-and-so year. Caber initiated operations and services from Chennai, and now the headquarters of the startup company is based in Pune. So one point is very clear. In case study, lot of times what happens is that, let us say below we have got some 5 MCQs and also descriptive based questions. Many times out of the total case study, there will always be 30-40% in the case study, which is not relevant for us at all for the questions what we are discussing. But all said and done, we need to go through that. That is the reason why we gently give an advice to the students telling that if the case study is too big, humble advice is that first go through the questions, then go through the case study so that you will be able to understand what to focus upon, what not to focus upon. But if that case study is not so big, it is always advised to go through the entire case study first so that you are very clear as to what part is there in the case study, and based on that, you'll be able to answer the questions. So moving further, so there is a Caber Caps, which is an Indian startup company, which is started in 2008 by a couple of persons, and headquarters is based out of Pune and all. Within a span of few years, they have expanded its base to many cities, and with around 2 lakh cars operational in its online cab services. Very good. Startup also went forward to provide auto rickshaw services in the middle class can of the Indian families. So it sounds as good as an Ola or Uber. Next. Caber's market share accounted for so and so, search pricing, that is all demand-based pricing. This is all not relevant for our taxation purposes. Next. Major customer segments of Caber are individuals who do not own a car or can't drive car on their own. So mobile app is developed, fine. So these are all the business model what they are following. Caber Cars is a digital aggregator app platform, of course, because they are connecting the passengers who need ride point from point A to point B with the drivers that are willing to serve them. So actually speaking, strictly speaking, the person who's providing the service is the driver. And the person who's receiving the service is the customer who is traveling in that cab. But who is the person who's connecting both of them, which is nothing but Caber Works, which is an aggregator, which is connecting the driver and the customer, which is nothing but an e-commerce operator, which is an online platform. Passengers generate the demand. Drivers supply the demand. Caber acts as a marketplace or facilitator to make all this happen seamlessly on a mobile platform. Caber has been able to generate strong value proposition for both passengers and driver to get on board on its platform and create disruption in the taxi or cab industry. Certain facilities provided by the Caber to passenger customers are convenient cab bookings, real-time tracking, ride-hailing services, which refers to ability of passengers to track the location. We obviously practically would have experienced that we are able to track the location from where we are traveling to where is the cab, till what point it has reached. All that will generally be able to track. All that will be generally able to track when it comes to e-commerce operator. They provide an app facility through which we will be able to track where is that vehicle and where are we traveling. Next. It promotes cashless rides by giving option to the passengers to pay their rides using digital methods such as debit card, wallets, and all these things. Very good. Waiting time, this is all about their business models. Then hiring department at Caber undertakes extensive search to hire experienced to drivers. Very good. After hiring its drivers, what is that they are doing? They are providing flexibility to drive on their own terms, setting their own schedule. Fine. This is all about how the business model is. Now see. Caber supports its drivers by facilitating access to vehicle loans, enabling them to become vehicle owners and enhance their earning potential. So basically, Caber is helping them to get vehicle loans as well. Through partnership with financial institution, Caber offers specialized loan programs with competitive interest rate and flexible repayment terms. Additionally, this is one method where they are organizing the loan or arranging the loan. But other way is Caber runs a vehicle leasing programs in many cities to help new drivers get on board faster. This is very interesting. So Caber, they are only purchasing vehicles and they are giving it on lease to the drivers. Drivers pay an upfront security deposit for the vehicle and the payments are automatically deducted on weekly basis from their earnings. Caber purchases motor vehicles or motor cars from Shakti Motors and leases out to its drivers. Wonderful. The lease agreement states that, what is that lease agreement stating, my dear friends? The lease agreement states that in case of default by the drivers for payment of lease rent or other term conditions, Caber has got power to repossess the cars leased out. So ultimately, who is the owner of the car? The owner of the car is Caber only, but they are giving that car on leasing. So they are basically in leasing business. They are leasing that cars to the driver. But the control of that vehicle is with Caber only. We can realize that control is with Caber because Caber has got power to repossess the vehicle in case where conditions are not satisfied or the drivers does not make payment of the lease rental. Next. Registration of vehicle is in the name of lessee as per provisions of Motor Vehicles Act. Very good. Registration of vehicle is in the name of lessee as per provisions of Motor Vehicles Act. Caber has claimed depreciation of 5 crore during the previous year 23-24 on the motor vehicle leased out. Very good. Caber takes money by taking a cut on each ride. That is some percentage of the transaction is taken by Caber. Caber provides the drivers on its platform with a robust supply of ride requests to accept, fulfill, and make income. While making a booking, the passenger pays Caber for the ride through the app. Caber then transfers the payment to driver's account after taking some amount of the tip commission for doing the job of a broker. Commission rates obviously keeps varying based on the market. And dynamics pricing is obviously done whenever there is a high demand, especially when they go to airports or in case where it is raining, they obviously charge more. So Caber app is a very popular app with millions of active users. Wonderful. This makes it a good option for the brands to do promotion. And the company offers discounts to end users. And they are offered in the form of end user discounts and promotion, end user referrals, market-wide promotions. Very good. So these are not relevant for my tax purposes. Caber offers 24/7 customer support. Very good. So sweet of them. And recently, they're planning to introduce customized luxury rides to attract high-end customers in all metropolitan cities in India best known for their fast-paced lifestyle. And due to expansion of business in various segments requiring restructuring in leadership team. So due to expansion of business in various segments, there was a requirement of restructuring in leadership team for effective management. The board has decided to increase the number of directors. Very good. KBAR wishes to diversify its current business in various segments to enhance the portfolio. And as per the board, new hands are required for decision making, for which qualified and experienced personnel are obviously required. KBAR's market share accounted for approximately 55%. And next is all about valuation. Sample fare breakup. X, one customer, books an auto for traveling from Jotwara, Jaipur to Sanganer, Jaipur. Y, an auto driver, a resident of Rajasthan, accepted the ride. On completion of the trip, the operator received a fare from X. A probable breakup of it can be as under. Driver fees 800, booking and convenience charges 200 rupees. Total is 1000 rupees is what will be collected from the customer. But what will be the GST? We will see. If they ask a question about GST, we will see. Which of the following statement describe characteristic of descriptive innovations of KBAR that is not related to GST or income tax? Yeah, second bit, our question, guys. With reference to fare breakup, what should be the total amount of fare and GST, assuming the rate of GST as 5%, if X hailing the raid is not claiming ITC on the above, and also who is the person liable to pay GST in this case? Friends, I'm sure you guys are aware about this concept very clearly. The concept is very simple. That is something like this. Let me share the screen on a different screen and share. Hold on. I'm sure you're able to see one Excel screen, my dear friends. Yeah, right. Let me write the concept here. Sir, listen carefully, please. In case of certain notified services supplied through e-commerce operator is liable to pay GST. And this concept is given by section 9.5, my dear friends. And what are covered in 9.5? Let me tell you. Number one, service of transportation of passengers by way of radio taxi, motor cab, maxi cab, omnibus, motorcycle, or any other motor vehicle, basically. Yeah, I'll leave it here. Second point, my dear friends, service of hotel accommodation except when person supplying service is liable to be registered. Next. Third interesting point is housekeeping services. Classic example, my dear friends, urban company. Housekeeping services. Student has answered rightly. It is housekeeping services except when person supplying service is liable to be registered. The concept is very simple. If the person supplying service is liable to be registered, he is only liable to pay GST. And the fourth latest concept, my dear friends, restaurant services. That is basically food. Restaurant service except from specified premises. And the note what I'll write is, my dear friends, specified premises means those restaurants which have accommodation facility and room tariff is more than 7,500 per day. That means if you order food from Star Hotel is what I'm trying to talk about. Getting the point, everybody? So in this given case, my dear friends, In this given case, it is covered in first point. Hence, the person liable to pay GST is Keber. And the amount of GST to be collected is 5%, which is equal to 1000 into 2.5%. 2.5% plus 2.5%. And the reason I'm writing 2.5% plus 2.5% because it is very clearly CGST and SGST. CGST 25 and SGST 25. So that is the story of this very, very brilliant, interesting MCQ what they asked. So a lot of times questions keep coming in the exam like this, where that clarity of thought is very important for us as to what will be applicable. So the answer in this case will be option A, my dear friends, because very clearly who is liable to pay GST is Keber Cap, and what will apply is CGST and SGST, which is 2.5% and 2.5%. That's it. Third question is not related to taxation. Fourth also is not taxation. Fifth also is not taxation. And coming to descriptive questions, the first is not tax, second is not tax, but the eighth one, with reference to a case, the depreciation claim is rejected by the officer on the ground that Keber had only financed for purchase of leased vehicles, and hence it is neither the owner nor use the same motor cars in his business. Comment the contention of the assessing officer. Very good. In fact, this same matter has come up with a case law of Supreme Court named as ICDS Limited. Very, very popular point, my dear friends. So, eighth point is what we are trying to discuss. Correct, no friends? Friends, come on, please reply. I hope we are getting complete clarity on this case study, what we are trying to understand, specifically from a taxation perspective, be it direct or indirect taxes, my dear friends. Yeah, some student is asking one query. Let me check. Yes, he is very clear. Excellent. Thank you so much. Yeah. First of all, let me tell you, section 13 deals with the concept of depreciation. That is very clear. And it clearly says owner can claim depreciation. Come on, who will claim depreciation, my dear friends? Owner only can claim depreciation, provided asset is used for the purpose of business. So friends, who can claim depreciation is only the owner, and that too we can claim only when it is used for the purpose of what, my dear friends? For the purpose of business. Getting clarity, everybody? All of us, my dear friends. Yeah, good. Good, very good. Now, let me write here very clearly. In the given case, car is used for the purpose of leasing business by Keber. And moreover, Keber has a right to repossess the vehicle. Accordingly, you're getting what I'm trying to say, my dear friends? He has got a right to repossess the vehicle. So he has got a right to get the legal title. Getting the point, my dear friends? All of us, please reply, my dear friends. Come on. Accordingly, Keber can claim depreciation since he has right to repossess and he is regarded as owner. And is regarded as what, my dear friends? Owner for a depreciation purpose. Is regarded as owner for a depreciation purpose. And moreover, at the end of lease period, lessee must return the vehicle to the lessor. Hence, Kaber can claim, what, my dear friends? Hence, Kaber can claim, what's that? Depreciation. Same point has been held by Supreme Court in the case of ICDS Limited. Very, very popular case law, my dear friends. Clear, everybody? I hope we got complete clarity on this interesting point. Clear? Done. Let me proceed. So let me talk about next interesting case study, my dear friends. It's Connect Limited, Connect Group, case study number 7. Please see that. This is also a very, very interesting case study. In fact, this case study, I liked it a lot because after a long time, some interesting section called Section 35 ABA, 35 ABB, license fees, that concept is covered in this particular case study. After a very long time, something related to that has come. I hope now it's clear. Right, see that. Connect Group, one of the India's largest conglomerates, was founded by Ramlal Jain in 1966. Initially starting as a small textile company named Connect Commercial Corporation, it rapidly expanded its operations. All this is story, my dear friends. Visionary leadership, following his passing. Group was divided between two sons, Vansh and Suhan Jain. Okay, very good. Connect Group is among India's top private sector business. Okay. And they're in telecommunication, power, financial service, infrastructure, media, and entertainment, and healthcare sectors. So many sectors they are there. Okay, the mission is to build a global enterprise. One of the Connect Group company, Connect India Limited, entered the Indian telecommunication landscape in 2002. Okay. Leveraging substantial resources, Connect India embarked on an ambitious journey to revolutionize connectivity in India by expanding its network in GSM and CDMA services. GSM, CDMA phones, inbuilt SIM. Reliance, you know that, no? They have done that magic of CDMA phones. Next. There is all a strategic move, disruptive approach. Very good. Now see here. In the 2010 Spectrum auction, CA acquired 3G licenses for 3 cities with a licensing fees of 57 billion. Oh my God. They acquired at a price of 57 billion, my dear friends. You understand my point, everybody? Exactly. Next. By leveraging MIMO technology in 2011, they improved the quality of 3G service. And in 2013, it managed a multi-year managed services, signed a multi-year managed services agreement with Startel to manage services of wireline and wireless network. Okay. This arrangement was smooth. By 2016, it discontinued CDMA operations. Okay. In 2016, they announced a merger with FreeCell, which was expected to help repay 250 billions of debt. Oh my God. Oof, oof. Their financial problems worsened when it couldn't repay Starlet under managed agreement, and the issue took to NCLT. So this question is all related to corporate law. Where is my tax then? Then the story is all coming about insolvency, bankruptcy code. Again, the provisions of law are coming into picture. Then now comes the real story. In 23-24, previous year. Oh, wait a second. Before that, as a part of the expansion, Connect acquired the right to use spectrum for a high frequency brand on April 1st, 2020 by making an upfront payment of 1,000 crores. By making 1,000 crores payment for the spectrum license, which is valid for a period of 20 years, he has taken on 1st April 2020. Clear, my dear friends? Everyone, come on, please reply. Yeah. Next. In the previous year, 23-24, that means 2021 is over, 21-22 is over, 22-23 is over. 3 years done. Now that story starts changing. Connect transferred a part of the spectrum for a consideration of 300 crores. Oh my God. A part of the spectrum license is sold when 17 years of the spectrum period was still remaining. After the spectrum was sold, there was a news in the industry that Moonlink Telecom was interested in buying the spectrum sold for a whooping amount of 900 crores. However, Moonlink Telecom was embroiled in a legal battle with the government over the disputed amount of 2,000 crores, complicating their potential acquisition. MCQ, first bit, that is about strategy, not related to taxation. Second bit is also not related to taxation. Third bit is about strategy. Fourth also is not about tax. Fifth is also not about tax. Sixth one is about law. Seventh one, portal 5 forces model. Evaluate effectiveness of valuation techniques. Finally, ninth question is related to your taxation. Compute deduction available to connect XG for previous year 23-24 and the amount chargeable to tax, if any, assuming that company has been claiming deduction since the year of acquisition of spectrum. Part of the license is sold already. Suppose if the part of the license was sold for 900 crores as per the bid by Moonlink, then what would be the taxability under income tax? Very, very interesting part of the question. Let me answer this. Case study number 7, question number 9. Let me share my Excel. Case study number 7, question number 9. Yeah, please see that. And that we are talking about question number 9, wherein I'm discussing about ABIT. As per section 35ABA, which section, my dear friends? 35ABA. Don't get it out. Sir, is it 35ABB? You have to understand that it is 35ABA because 35ABB talks about telecom license. 35ABA talks about spectrum license. Are we getting clarity on this point, everybody? All of us? Yeah. As per 35ABA, my dear friends, telecom license fee paid is allowed as deduction in proportion to years of license. In the given case, it is 20 years license and 3 years have lapsed. And in 23-24, what has happened, my dear friends? Part of the license is sold. For how much value they told in the question? Let me check. Part of the license is sold. Yeah, part of the license is sold for 300 crores, my dear friends. Come on, please understand that part of the license is sold for 300 crores. Sold for 300 crores. Part of the license is sold for what value, my dear friends? 300 crores. Just speak out. Now, deduction already claimed till 22-23 is how much, my dear friends? 1000 crores divided by 20 into 3 years. Correct or not? 1000 divided by 20 is nothing but 50 crores. That means totally 150 crore deduction is already taken. 150 crore deduction is already taken. Expenditure remaining is 850 crores. And part of license is sold for what value, my dear friends? 150 crores. Wait a second. Part of license is sold for 300 crores. 100 crores is the deduction what we have taken. No? Part of license is sold for 300 crores. Correct, my dear friends? Everybody said. Now, what they told in the law is, my dear friends, deduction under section 35ABA will be whatever is the remaining amount minus proceeds what you already got. What are the proceeds you already got? Proceeds what you already got is 300 crores. Correct, no, my dear friends? So what I'm trying to tell you is that, see, 850 from that already you got 300 crores divided by 17 years. Why I'll take 17 years? Because the balance period of license is only 17 years. So deduction what I'll get is, my dear friends, let me calculate. 550 divided by 17. 32.35 crores. 32.35 crores is the deduction for previous year 23-24. This is what is the story which happens when the part of the license is sold and whatever amount we got is less than the expenditure remaining unallowed. Getting clarity, my dear friends? And no other tax treatment. Now, BBIT, what they told is part of license is sold for 900 crores. That is what they told in the BBIT, my dear friends. So in case where sale price is more than the expenditure remaining unallowed, that is nothing but 850 crores, so my dear friends. Expenditure remaining allowed is 850 crores, but we sold for what value, my dear friends? Come on, we sold for what value? We sold for 900 crores. Are we getting clarity, everybody, sir? Speak out, my dear friends. All of us. In that case, the amount taxable under PGBP is PGBP is lower of number one, difference between sale price and expenditure remaining unallowed. Number two, deduction already claimed. The difference between sale price and expenditure remaining unallowed is nothing but 50 crores. Deduction already claimed, that is 150 crores. So hence, my dear friends, the amount which will be taxable under PGBP is 50 crores. Are we getting clarity, my dear friends? All of us, come on, please reply, sir. So if the license is sold, and the sale price is more than the expenditure which is remaining unallowed, my dear friends, whatever expenditure you have taken till now or the excess amount, that will be taxed under PGBP. Are we getting clarity, everybody, sir? All of us, that's it. That's the end of story of this very, very interesting case study wherein they spoke about spectrum license. That's all, my dear friends. That's all for this particular session. The balance case studies will take up in next session, my dear friends. Thank you so very much. Take care. See you all in next session. Shivateja signing off. Any doubts with respect to taxation, feel free to post on our forum query. We'll be more than happy to reply, my dear friends. Thank you so much. Bye-bye. Hello, my dear students. So friends, in the previous session, we have discussed some interesting case studies in relation to IBS, specifically from a taxation perspective with respect to the tax issues in some case studies related to IBS. So this particular session as well, we'll discuss some more interesting case study from the taxation perspective, be it direct tax or indirect tax, from both perspectives we'll discuss, and we'll also talk about some interesting elements in that particular case study which are revolving around the concepts of direct and indirect taxes. So without any delay, let me share the screen and start the discussion, my dear friends. Yeah, I'm sure the screen is visible for all of you. Done. Sounds good. Please see that, my dear friends. We are looking at something called case study number 12, an interesting case study. This case study has got one interesting concept about taxation. Let's see what is that. MNO Limited is a renowned powerhouse in the FMCG sector, known for a wide range of household products and robust network across urban centers. This is all a story what goes on in every case study. Despite its strong market position, they have been facing challenges in penetrating rural markets. And Peak Limited, on the other hand, is a rising star in FMCG landscape with a strong foothold in rural areas and an innovative line of eco-friendly organic products. PQR Limited's unique approach to utilizing local resources and its sustainable supply chain has earned it a loyal customer base and recognition for green initiative. So this is the background what they have given for MNO Limited and the background what they have given for PQR Limited. As consumer trends shift towards healthier and happier, more sustainable products, MNO Limited recognizes the need to adapt its product offering and the market approach. And a leadership team led by visionary CEO conducts a strategic review and identifies the acquisition of the company aligned with these emerging trends as a critical pivot for future growth. MNO Limited embarks on a search for a suitable acquisition target with PQR Limited, quickly emerging as a front runner due to its innovative product line and strong rural penetration. PQR Limited practices also align with MNO Limited's long-term vision of sustainability and social responsibility. Wonderful. So these are all the background what they gave for MNO Limited and PQR Limited. Next line you see, my dear friends. MNO Limited decides to acquire PQR Limited by merger, and the following data is available in respect of both the companies. MNO Limited data is given, PQR data is given. Number of shares, market value, earnings after tax, practically we call it as PAT, profit after tax. Summarized balance sheet is also given, where we have got current assets, non-current assets, current liabilities, non-current liabilities, equity shares, retained earnings. Then, MNO Limited has decided to acquire PQR Limited by acquiring its shares. And MNO Limited prepared a scheme by which an offer was made to shareholders. So these are all not related to taxation as such. And minority shareholders, very good. Next line, you see. So that's all not related to tax. Let me move forward to content which is relevant for our taxation purpose, my dear friends. Pre-merger, PQR Limited had a block of asset carrying 15% rate of depreciation. We all know that under income tax law, depreciation is charged based on block of asset. We don't follow asset by asset approach. We follow something called block of asset. So pre-merger, PQR Limited had a block of asset carrying 15% rate of depreciation, whose WDV as on 31st March 23, after reducing depreciation of 2023 was 4 lakh rupees. It purchased another asset, second-hand plant and machinery of the same block on 1/11/23 for 1.44 lakhs. You have to observe an interesting element that excuse me. You have to observe an interesting element that the new asset is acquired of the same block on 1st November 2023 for 1.44 lakhs. If you observe carefully, it is purchased on 1st of November 2023. We all know the concept that in the year of purchase, if the asset is put to use for 180 days or more, we can claim full depreciation. However, in the year of purchase, if asset is put to use for less than 180 days, we can claim only half of normal depreciation. Next, here since they told 1st of November, my dear friends, obviously we can take only half of normal depreciation. PQR Limited was merged with MNO Limited with effect from 1/1/2024. Next, post-merger, directors of PQR Limited are appointed. That is all related to your company law. And despite acquisition, post-merger, there continues independent division. They'll have separate COOs, better performance, overall cost of capital is given. That's it. So from taxation perspective, what is the relevant element is only your the block of asset story depreciation. And PQR was merged with MNO with effect from 1/1/2024. See next. Multiple choice question. The first one is not related to tax. Second one also is not related to tax as such. The third MCQ is the exchange ratio of goodwill. Next one is the accounting question, fourth one. Fifth one is the residual income, alternate method of measuring. Fine. Descriptive question, sixth one. A has approached you for advice regarding concerns, acquisition of shares. Very good. Seventh one you see, guys. What is the eighth one? Merger is carried out. What is the impact on EPS? But seventh one, you see, you are required to compute what is the depreciation allowable under income tax in respect of block of asset carrying 15% rate of depreciation to MNO Limited and PQR Limited for the previous year ending 31st March 2024. So in the entire case study, only this particular paragraph is what is relevant for us from the taxation standpoint, my dear friends. Come on, let me share the Excel, what we have used earlier as well. See that, my dear friends. We are looking at case study number 12, question number 7. First of all, let me write the concept here very clearly, my dear friends. In case of, this line is very important. In case of reorganization of business, reorganization of business means what? Something like merger, demerger, amalgamation and all. In case of reorganization of business, depreciation shall be computed as if there is no change, and then apportioned between amalgamating company and amalgamated company in the ratio of number of days of usage. So that means law is very clearly telling first to compute depreciation as if there is no change, and then apportion between the amalgamating and amalgamated company. In our question, it is nothing but PQR Limited and MNO Limited. Clear, friends? In the ratio of what? Number of days of usage. Now, first of all, what is the opening WDV on 1/4/2023, my dear friends? Excuse me. Opening WDV as on 1/4/2023 is 4 lakh rupees, my dear friends. To that I will add asset purchased on 1/11/2023. When is asset purchased, my dear friends? 1/11/2023 for 1,44,000. From that, we will reduce asset sold. If any asset is sold, that will reduce. But in this particular case, nothing is sold. So I'll take the figure as 0. Next figure is closing WDV, which is the opening WDV plus asset purchase minus asset sold, which is nothing but 5,44,000, which becomes my closing WDV. I'm sure we are getting clarity on this point. So this is my closing WDV, my dear friends. Now, how do I calculate depreciation? Now, depreciation will be, depreciation on 1,44,000 will be 1,44,000 into 15% into 1/2. Obviously, because I'm only going to claim half of normal depreciation. Why will I claim half of normal depreciation? Is because the asset is put to use for less than 180 days. When asset is put to use for less than 180 days, I'll only claim half of normal depreciation. And the depreciation on 4 lakhs figure will be 4 lakhs into 15%, which is coming to 60,000 rupees. Now let me talk about the concept of apportionment of depreciation. And this I will take it to whom, my dear friends? We will take it to PQR Limited, MNO Limited, because I have to divide between PQR Limited and MNO Limited in the ratio of what? In the ratio of number of days of usage. I clearly told you this point that will apportion based on number of days of usage. Are we clear with this, everybody? Exactly. Now, come on. First of all, on opening WDV, what is the depreciation I claim? 60,000 rupees. And when is the merger happened? In the question, they clearly told that merger happened on 1st of January. Merger happened on 1st of January 2024. That means 1st April to 31st December, it is there with PQR Limited, and post that it is there with MNO Limited. Clear, my dear friends? So opening WDV, what is the depreciation figure? Depreciation figure is 60,000 rupees. Into how many days I should take from April to December? Let me calculate, my dear friends. April to December. April 30, May 31, June 30, July 31, August 31, September 30, October 31, November 30, December 31. Total is 275 days. And Jan, Feb, March is how many days? Jan is 31, February 29 because 2024 leap year, and March is again 31. Total is 91 days. So this I will take it as 60,000 into 275 divided by 366. And this will be 60,000 into 91 divided by 366. This is how I'm going to calculate or apportion the depreciation between PQR Limited and MNO Limited. I hope we are getting clarity, all of us. Let me round off the decimals. Yeah, next. On new asset, my dear friends, new asset, what is the depreciation? 10,800. But you should not directly do 275 by 366. I'll tell you why. Because this 10,800 into what you have to observe very clearly is that for new asset, my dear friends, it is purchased on 1st of November. That means November and December, it is used by PQR Limited. November and December will be 30 plus 31. That's it. Only 61 days it is used by PQR Limited. And 91 days it is used by MNO Limited. And total period is only 152 days. This you have to be very clear. You should not get that doubts of why we have done this. Because for the open WDV, it is there from 1st April. But the new asset, what we purchased, it has come into existence only from 1st of November. Then how can I take 275 days? So that will be 10,800 into 61 divided by 152. And this is again 10,800 into 91 divided by 152. That's it. So the depreciation that will be allowed to PQR Limited is 49416 and MNO Limited is 21384. So that is the story of this very, very interesting question. And I strongly believe that you got clarity on this point, my dear friends. Everyone, this concept is clearly related to what, my dear friends? Depreciation. And that too in case where there is a business reorganization. We'll compute depreciation as if there is no change and then apportion that based on what, my dear friends? Number of days of usage. We'll apportion based on number of days of usage. That's it. Now let me open the next case study, guys. Hold on. Just a second. Yeah, I'm sure it's visible now. Yes. Please look at now once case study number 15, my dear friends. This is related to some interesting concept of direct taxes. So let's see that. NGOs are non-profit entities. NGOs are non-profit entities working independent of the government. UN Department of Global Communication defines an NGO as not-for-profit voluntary citizens group that is organized on a local, national, or international level to address issues in support of public good. Then, task-oriented and made up of people with a common interest, NGOs perform a variety of services and humanitarian functions, bring citizens' concerns to government, monitors policy. Very good. All this is story. NGOs have become very influential and prominent in world affairs, and a substantial chunk is rooted through NGOs. Okay. Next, foreign contributions are regulated by Foreign Contribution Regulation Act. So FCR also has come into picture. DSP Trust is one such organization working in the field of preserving ecology and environment. It has been working on environmental issues since last few years, and it is very vocal and prominent in raising issues. However, the trust is overzealous in its approach and has sometimes been accused of stalling crucial development projects in guise of protecting environment. It also receives substantial foreign donations from overseas agencies, trusts, and well-wishers. And such donations are the main source of funding for carrying out activities of the trust. Office bearers of the trust met on 25th March 2023 to take stock of situation arising from amendments to FCRA law and rules in the recent past. One of the office bearers, Mr. X. So it's all about FCRA, my dear friends. Agreed with them about FCRA. Yeah. During meeting, Mr. Z also chipped in. He also reminisces that there had been changes in rules pertaining to registration of charitable trust under income tax law. Very good in the recent past. And new procedure was complied with the trust in 2021 by filing application in Form 10A. However, he wants to be clear about modalities of renewal of registration under income tax law whenever it falls due for renewal next time. Besides, trust is planning to sell during the financial year an immovable property held under trust wholly for charitable purposes since last 5 years. So since last 5 years, there is some property which is held by the trust for charitable purposes. And the whole of the net consideration is to be invested for acquiring another capital asset. if the entire consideration is used for acquiring another capital asset, my dear friends, then it is deemed that the entire capital gains is utilized for charitable purposes. The trust has recently appointed their new auditor and tax consultant CA Madhusudan. Mr. Z is of the view that they should consult their tax consultant in respect of these matters for necessary guidance. CA Madhusudan has also to audit account of foreign contribution, foreign balance. Okay. Done. First bit is about FCRA. Second bit is also about FCRA, foreign contributions. Next, third bit, that is also not related to tax. Fourth one, you see, my dear friends, this is an interesting point. Fourth point is a very, very interesting point. First point, second point, third point, and all may not be related to taxation, but fourth one is very clearly related to taxation, my dear friends. Z, an office bearer of the trust, has approached CA Madhusudan to seek advice regarding modalities of renewal of registration of trust under income tax. Which of the following advice is to be rendered by Madhusudan in according provisions of the law? Registration application is to be made in form 10B. No, my dear friends, let me tell you, the answer is application is to be made in one form called form 10AB. Registration is to be made in form 10AB at least 6 months prior to expiry date of registration of trust. Wonderful. This is the answer. Further, copy of registration under FCRA is mandatory with application as it is registered under FCRA. Option C, they told it is not mandatory. No, that is not correct. So answer is very clearly option B, my dear friends. Because registration application is to be made in form 10AB at least 6 months prior to expiry date of registration of trust. And the copy of registration under FCRA is mandatory, my dear friends, since they are registered under FCRA Act, my dear friends. Are we clear with this point, everybody? Very, very interesting point, guys. Clear with this? Next, moving ahead, my dear friends. Moving ahead. Fifth point is also related to FCRA. So let's not talk about it. Descriptive questions, my dear friends. First one is again related to FCRA. And what factors should be considered audit-based risk? 7B is again FCRA, my dear friends. Look at question number 8. What should be proper advice of CA Madhusudan to Z regarding implication of proposed sale of capital asset and acquisition of another capital asset as described in the case study? That is a straightforward answer, my dear friends. Straightforward answer for that is, my dear friends, very clearly, I told you the answer, that in case where there is an asset which has been acquired by the trust and the trust intends to sell that asset. Let me tell you, my dear friends, this concept is actually given by one section called section 11(1)(a), which clearly says that whenever an asset or property is held for charitable purpose and that is transferred, the capital gains, whatever capital gain we get, if the entire net consideration is used for acquiring new asset, my dear friends, then the entire capital gain is deemed to have been applied for a charitable purpose. Very, very clearly an interesting point, my dear friends. As per section 11(1)(a), if a property held for charitable purpose is transferred. Come on, my dear friends, what is that line about? If a property held for charitable purpose is transferred, then the net consideration is to be utilized for the purpose of what is that line, my dear friends? It should be utilized for the purpose of what, my dear friends? For the purpose of acquiring another capital asset. And next line, if entire net consideration is utilized for charitable purposes, is utilized for acquiring another capital asset, then the entire capital gains is deemed to have been applied for charitable purposes. Entire capital gains is deemed to have been applied for what purposes, my dear friends? Entire capital gains is deemed to have been applied for charitable purposes. So that's the story of this very, very interesting case study, guys. I'm sure, pretty confident and sure that you guys are getting clarity on this case studies, guys. Yeah. So without delay, what we'll do is in this particular session, we'll also discuss one more interesting case study. And this case study talks more about indirect taxation, that is your GST part and customs part. Let's see that, my dear friends. Let me open that. 1 second. Come on, please see that, my dear friends. Case study number 70. Max Plus Limited, hereinafter referred to as the company, one of the most trusted gateways to medicine incorporated in Delhi, with an aim to eliminate fake and ineffective medicines and supply good quality medicines in India. Very good. According to WHO research, every 1 or 2 in 10 medicines are adulterated in low or medium income countries like India. Consequently, company aspires to bring about a change in these statistics. So basically, they want to supply good quality medicines, but not adulterated medicines. To improve transparency in functioning of pharmaceutical industry, company has been successfully contributing to provide genuine and unadulterated medicines since incorporation. Also, as the market demands, a constant customer loyalty program is also introduced by the company, wherein on eligible purchases, customer can avail cash discount or can enjoy incentive points, which can be converted into required products like blood pressure testing apparatus, diabetes testing apparatus, medicated or central floor care, etc. Entire operation of the company can be broadly classified as retail outlet, agency division. Okay, retail outlet, all the story they are given. Now let us see here. With regard to the outlet, company through its legal wing enters into 3 years lease agreement with the landlords for operating its stores in all the cities. And as a part of vendor registration, company captures all the details of landlord like PAN, TDS deductibility, MSME registration status, GSTN details, type of building, whether commercial or residential, onus of payment of electricity, etc. at the time of entering into lease agreement. At the time of entering into what agreement, my dear friends? Lease agreement. So all the details are being captured. According to the vendor database maintained by the company, out of 100 landlords, only 50 landlords are registered in GST law and raise GST invoices. Obviously, not necessary that every landlord should be registered in GST unless their aggregate turnover exceeds threshold limit of 20 lakhs or 10 lakhs. Don't tell 40 lakhs because 40 lakhs is only in case of goods. That too in only specific states. 10 other landlords are registered under MSME Act. All the lease contracts stipulate the lessor will perform maintenance of the leased area and receive consideration for that maintenance service. Lessor will perform maintenance and receive consideration for that service. Okay. Next. Company is capable of selecting similar places in different cities having similar lease rent. And it's also capable of finalizing all the lease contract with similar terms. The contract includes fixed monthly prices at the end of every year for lease and non-lease component. 27,000 lease amount, 3,000 maintenance amount, total 30,000. Company has ability to forecast demand for the products. Demand is continuous, working capital, inventory is stocked up, okay. Company is also the leading trader of extensive array of medical equipment, okay. They regularly purchase different varieties of medicines through procurement system and they are distributed to outlets, which are sold to customers. Unsold medicines are held as stock in hand. However, it buys medical equipment only when customer gives purchase order along with product specification. Only when customer is giving purchase order, at that time only they'll procure the goods. The delivery of medical equipment is directly done by corporate office. During the financial year, Max Plus has imported CT scan machine by air. It is imported by air. So they are talking about customs. And provided this machine to a hospital governed by charitable trust. Hospital is registered under 12AB of income tax and involved in healthcare service. Very good. See now. Ex-factory price is given. Freight from factory of exporter to load airports. But we all know that if goods are imported by air, we will take actual freight or 20% of FOB, whichever is lower. And once I take 20% of FOB, entire cost of transport, loading, unloading is deemed to have been covered. Next. Insurance charges $2,000. Okay. Though the aircraft arrived on 22nd of August, Bill of entry for home consumption was presented on 20th of August. So what we do is, my dear friends, for the purpose of exchange rate, we will see 20th of August. I repeat again, for the purpose of exchange rate, we will see 20th of August. But for the purpose of duty rate, we'll see 22nd August. The reason being, for the purpose of duty rate, we always consider the date of filing bill of entry for home consumption or date of arrival, whichever is later, my dear friends. The chief tax officer, CTO of the company, is uncertain about the computation of assessable value. He needs clarity about the following issue. We'll give which rate of basic customs duty and exchange rate should be applied, whether the rate prevailing on arrival of aircraft or the rate prevailing on presentation of bill of entry. Which rate of exchange should be applied, either CBIC or RBI? Of course, we are going to apply the exchange rate of CBIC. This is very clearly valuation concept, my dear friends. And the rate of BCD on 20th August was 20%. 21st August onwards, it is reduced to 10%. What we'll take is 10% only, because duty rate is considered on the date of filing bill of entry for home consumption or arrival, whichever is later. He furnishes all the relevant details. Exchange rate notified is CBIC 80 and 83. I'll take 80 because of the reason that I will see on date of filing bill of entry. Exchange rate of RBI, it is irrelevant. IGST, I will take it after adding BCD and SWS. SWS means what? Social welfare surcharge. For the import of aforesaid machine, company is liable to settle the exporter in 3 months. Okay. Forward contract, hedge contract, okay. Call option, put option. Not related to tax. So some outlet details are given. Okay. Average time spent, more footfalls, year 1, year 2, one-time expense. 50% of them visit pharmacy, 75% visit outlet, health supplements, okay. Done. Such a big case study, man. Such a big case study. That's why we always give that idea to the student. Whenever the case study is too big, first go through the MCQs and then look at what part is relevant in the case study. If the case study is not too big, directly study the case study first. Next. These are relevant here other than taxation. So first bit, how would company classify loan? Next is promoter's contribution. Next is supply chain model, franchisee model, okay. During 23-24, if the cost of all other common inputs other than lease rent is 200 crores and the total sales is 300 crores, 60% attract 18% GST and the balance are exempt supplies. Oh my God. What is the amount of eligible ITC attributed for affecting taxable supplies by the company? Very interesting. We are talking about apportionment of credit in case of common credits. We all know the concept. How do we do this? Let me write here. Case study number 17. And we are talking about which MCQ, my dear friends? MCQ number 5. In case where inputs or input services are used both for the purpose of taxable and exempt supplies, then the ITC related to taxable supplies shall be allowed. So basically, we are talking about something called apportionment of input tax credits. So that is called apportionment of input tax credit. In the question, if you very clearly see what is the common ITC other than rent, my dear friends, they give the figure as 200 crores. 200 into 18%, which is nothing but 36 crores, my dear friends. Next. What about rent, my dear friends? Rent is nothing but 30,000 per month into 12 months into 50 landlords into 18%. 32 lakhs 40,000. I hope you understood this working because it is 30,000 per month into 12 months into 50 landlords into 18%. So total common ITC. Come on, my dear friends. What is total common ITC? 36 crores, 32 lakhs, 40,000. 36 crore, 32 lakh, 40, 1, 2, 3. So ITC related to taxable supply. What they told in the question very clearly, 60% is only taxable supplies, my dear friends. So this into 60% if I do, I'll get my answer, which is nothing but 21 crores 79 lakhs 44,000. 21 crores 79 lakhs 44,000. That becomes my answer for this particular question. 21 crores 79 lakhs 44,000. So answer is option C, my dear friends. So that's the story of this interesting common ITC apportionment. Descriptive question, compute the value of CT scan machine for levying customs duty. I'll do that. Next is about forward market cover. Next is about restatement. Next is about present value annuity. Fine. So only thing left now in the discussion, the question is only about that, what do you call, my dear friends? Customs duty computation. I'll go back to the question. Jump. I'll share the screen. 8,500, 250, 250, 4,000 insurance, 2,000. Okay. What is the ex-factory price, my dear friends? Ex-factory price is $8,500. Correct or not, my dear friends? Ex-factory is nothing but $8,500. Other side, I will do one working note. That working note is, my dear friends, freight from factory to port. Freight from what? Factory to port in the foreign country, which is nothing but $250. That is what they gave in the question. Next, freight loading and handling charges. Loading charges, how much is that, my dear friends? That is also again $250. Next, freight from US to India. That means loading port to Indian port, $4,500. So in the question, they gave it as $4,500. So total cost of freight is nothing but $5,000. But one point to be noted is that if goods are imported by air, then the freight shall be actual freight or 20% of FOB, whichever is lower. Actual freight or what, my dear friends? 20% of FOB, whichever is lower. This is very, very interesting point. Are we getting clarity, everybody? Now, what will be the working for FOB? Let me do that working as well, so that you get a clarity. Come on, friends, please concentrate. An interesting discussion is what we are trying to do here. Yeah, my FOB is nothing but $8,500 ex-factory price, $250, which is nothing but freight from factory to port, plus $250 loading charges in factory, in the port. That is loading charges in US, in simple terms. So 20% of FOB is nothing but 20% of $9,000, which is $1,800. So what I'm going to do is, here, the freight figure, what I'm going to take is only $1,800. I'm pretty confident and sure that you understood this working, my dear friends. Very good. Insurance, they gave in the question $2,000. Sorry. $2,000. Now CIF is nothing but 8,500 plus 1,800 plus 2,000, which comes to $12,300. Now CIF in INR is equal to 12,300 into 80 per dollar, which is nothing but 9,84,000. That is my CIF in Indian rupees. Now, what will be the BCD? BCD, of course, I'll take at the rate of 10% only, my dear friends. The reason, because we will see the date of filing bill of entry or arrival, whichever is later. But for exchange rate, we will always see the date of filing bill of entry. Next. SWS at the rate of 10% of BCD, which is nothing but this into 10%. Total for IGST is 10,92,940, my dear friends. On that, we'll charge IGST at the rate of 12%. This into 12%. 12% only, right? Let me check once. I remember as 12% only. 1 second. Yeah, IGST 12% only. Which day we are going to take duty rate, that only will take GST as well. So total customs duty is equal to PCD plus SWS plus IGST. That becomes my total customs duty. This is nothing but 2,39,308.8. And we'll round off 2,39,309. So that's the story of this very, very interesting case study. In fact, very clear-cut question. This kind of question already we solved a lot in indirect taxes as well, where we spoke in valuation under a customs topic. So that's the end of story for this particular lecture, my dear friends. Next lecture, I'll see you again with some more interesting case studies. Thank you so very much. Take care. Bye-bye. Shivateja signing off. Hello, my dear students. Welcome back to discussion about some more interesting case studies of IBS, especially from the point of view of direct and indirect taxation standpoint. And today, in this particular session, we'll talk about some interesting case studies where we have got some good points related to direct and indirect taxes. So without any delay, let me start sharing the screen and start the discussion, my dear friends. Yeah, I believe the screen is visible for all of you. Yes, fair enough. Sounds good. So let me start the discussion without any delay. I'm looking at an interesting case study number 22. So please see that. Mr. Manish registered under GST. So the moment the first line starts with the word registered under GST, it's very clear that this case law talks about some interesting elements of indirect tax laws. Registered under GST is a chartered accountant, resident of Pune. So Manish is a registered under GST, resident of Pune. Manish has received technical consultancy services for his business from his brother. From whom, my dear friends? From his brother, Gaurav, who is well settled, financially independent in Canada. Why this point is important is very clear, my dear friends, that whenever we have got one interesting concept in section 7.1c, read with schedule 1, we have got some good concept known as transactions regarded as supply, even though there is no consideration. There are some interesting cases where it is regarded as supply, even though there is no consideration. In that, there is one point which talks about import of services by a person from a related person or from any establishment outside India in the course of furtherance of business is regarded as supply, even though there is no consideration. But related person covers one important point called members of the family. And this word family is defined in the law. Family covers two interesting cases. Number one, spouse and children of the individual. What is number one, my dear friends? Family covers number one, spouse and children of the individual. Number two, parents, grandparents, brothers and sisters, only if they are dependent wholly or mainly. Who is covered there? Parents, grandparents, brothers and sisters, only if they are dependent wholly or mainly. But in this particular scenario, if you see, they have given that he has taken service from his brother Gaurav, who is well settled and financially independent. That means with his brother Gaurav is not dependent on Manish. When Gaurav brother is not dependent on Manish, he is not regarded as members of the family as per GST law. And the moment we say that they are not members of the family, they are not regarded as related persons as per GST provisions. So as per GST provisions, they are not regarded as related persons. Next slide. His brother did not wish to charge any consideration from him for the same. But on insistence of Manish, he charged 20,000 rupees from him. Even though no consideration they wanted to charge, but on insistence of Manish, he charged 20,000. So that itself will become the value of service. However, he charges 2 lakh rupees from other clients in India for the same work. Very good. Interesting point. Generally, if you observe 2 lakhs is the open market value, but he charged only 20,000. So what is that we are going to consider? We know that in valuation rules, we have got an interesting rule called Rule 28, which talks about supply between distinct or related person. But that valuation rule called Rule 28 will not apply in the given scenario because his brother is not a related person to him, since brother is financially independent. And the moment we say that he is not a related person, Rule 28 will not come into picture. And if Rule 28 is not coming into picture, value of supply is always the transaction value, which is nothing but the price paid or payable when supplier and recipient are not related and the price is sole consideration. In this case, both are not related person and the price is sole consideration. So straight away the answer will become 20,000, which is value of supply. Next slide. Further, one of its clients, Gupta Sweets, a store located and registered under GST in Maharashtra, had come out with a big discount offer at the time of Diwali on various gift items. In order to attract more customers, it had decided to supply a gift pack containing 5 packets of Ladilas Namkeen, taxable at 12%, 1 packet of roasted smoked almonds, taxable at 18%, 1 packet of Cornwall chocolate, taxable at 28%, and 1 bottle of Teal fresh juice, 1 liter, taxable at 18% in a single basket for a single price of 600. This word is very important, for a single price of 600. Now, in this case, my dear friends, when the multiple items, what is that word, my dear friends? When the multiple items are supplied for a single price and they are not naturally bundled, what do you call that supply as, my dear friends? This supply is known as mixed supply, because we know that composite supply is different, mixed supply is different. Composite supply is a case where 2 or more taxable supplies are naturally bundled and one of which is a principal supply. And we know that composite supply is taxable at the rate of principal supply. But this case is not a case of composite supply, because this is clearly a case where 2 or more supplies are not naturally bundled and they are given for single price. Single price is an important element in case of mixed supply. And clearly mixed supply says, in case of mixed supply, they are taxable at highest rate. In case of mixed supply, they are taxable at what rate, my dear friends? Highest rate. Next point. Manish provides management consultancy internal audit services to his clients. And during 2023, looking into the growing needs of his clients to invest in stock market, he also advised them on portfolio management services, whereby he managed portfolios. Okay. And he approached Manish to take guidance on financial management. Okay. Manish was appointed as internal auditor. Okay. And the company was founded by Rajesh Kapoor, physician. So this is all the story related to the company's audit. Next. Kapoor Private Pharma Limited was considering its project, namely Dehradun plant, Borsar plant, for establishing manufacturing units. And NPD is given, standard deviation is given. It has got nothing to do with taxation. Kapoor Pharma has 200 employees who are each entitled to 5 working days of paid leaves, or if paid sick leaves for each year. Unused sick leaves and all is given. Average leave entitlement is given. Entity expected additional 12 days of sick pay. Okay. Further, company has post-employment medical plan, which will reimburse 15% of employees post-medical cost if employee leaves after more than 10 and less than 12 years of service. Okay. And 40% if the employee leaves after 20 or more years of service. The assessing officer within his jurisdiction, surveyed the primary business place of Kapoor at 11 p.m. Oh my God. They are conducting survey at 11 p.m. So we need to recall something called Section 133A of Income Tax Act. Is 11 p.m. okay? First of all, it's not about 11 p.m. or 12 p.m. What is okay is only during business place, that too at business place during working hours. Let us see what is working hours. The place is kept open for business every day between 10 a.m. to 12 p.m. midnight. When the place is open for 10 a.m. to 12 p.m. midnight and is coming at 11 p.m., there's no problem at all, because he has come during working. He impounded and retained in his custody books of accounts and other documents inspected by him after recording his reasons for doing so for 12 days. Okay, no problem, 15 days, up to that much is fine. Kapoor Pharma is producing medication products and can be called high volume based production environment. That's not related to tax. Done. Let's see the story here. Multiple choice question. What is the place of supply and value of supply of event management service received from his brother Gaurav? Come on, friends, let me answer this. Let me share my Excel. Yeah. Case study number 22, MCQ number 1. The point to be noted is that in the given case, they are not related persons. Since brother is not dependent, so not a related person at all, my dear friends. So that is a basic fundamental point what we have to note first, that they are not related persons. Since they are not related persons, transaction value itself, what is that word, sir? Transaction value itself becomes the value of supply. That is 20,000. You're getting my point, my dear friends, everyone? Since they are not related person, transaction value itself becomes the value of supply. Further, place of supply is determined as per section 13. Since supplier or recipient is outside India. Is what, my dear friends? Outside India. I hope you are getting clarity, my dear friends, everyone. Come on, friends, please reply. Exactly. Now, POS for technical services shall be determined as per section 13(2), and POS shall be location of recipient if it is available in the ordinary course of business. Hence, POS shall be what, my dear friends? India, which is nothing but Pune. POS shall be what, my dear friends? India. In our example, in our question, it is nothing but Pune, my dear friends. Friends, I'm sure we are getting clarity on this point, everybody. So what is the answer, my dear friends? The answer is very clearly option A, Pune and 20,000. Next point. Calculate the amount of GST payable in respect of supply of gift pack in the form of single basket by Gupta Sweets. Tell me, my dear friends, what will be the answer for that single basket? The point is very clear that it will become a mix supply. Correct, right? When it is mix supply, we'll tax at what rate? Mix supply will always taxable at highest rate. Let me go back and see the value. They clearly give the single price value at 600 rupees. GST is inclusive. And will tax at what rate? Highest rate, that is nothing but 28%. So on 600, directly I can't calculate 28% because that is inclusive of GST. So my working has to be 600 into 28 divided by 128. Let me calculate, my dear friends. 600 into 28 divided by 128, it is coming to 131.25. What is it coming to, my dear friends? 131.25. So net effect, it is rounded off to 131. So answer is option D, my dear friends. So for second question, the answer is option D. So these are the two interesting points in this question related to GST. Let's see if there are something else. Third one related to audit. Fourth one is not income tax. Fifth one, which of the following statement is correct in respect of survey conducted at business place of Kapoor Pharma Limited? Come on, my dear friends, think properly and tell me the answer. Which one is correct, my dear friends? Is he correct coming at 11 p.m.? Come on, friends, please reply. 101% answer is yes, because he can come at 11 p.m. And moreover, the documents, whatever he has impounded, that is also in order, my dear friends. The reason being very clearly that he can impound for a maximum period of 15 days. Are we getting clarity? And if you want the return beyond 15 days also, they can do that, but they have to obtain the approval of Principal Chief Commissioner or Chief Commissioner. I strongly believe that we are getting clarity on this point. A very interesting case study and makes a lot of sense, my dear friends. Can I proceed? Good. Thank you. Descriptive questions. First one, which project is recommended? That's a decision-making perspective. And seventh point, comment whether the requires recognize any liability that is related to Ind AS. That's it. And state the benefit to be attributed to employee for last 20 years. And finally, they're asking automated machine compute OEE. Clear, friends? Exactly. That's it. So that's also not related to taxation. So that's the end of story of this case study from taxation perspective, my dear friends. I strongly believe that we got good clarity on this case study, guys. An interesting case study, makes a lot of sense. Mr. Manish, Chartered Accountant case study. Now let me go to the next case study, guys. I'll share the screen just a second. Case study number, 1 second. I'm just sharing the screen. I hope now the screen is visible. Perfect. Please see that. Case study number 25. Fresh Foods is a popular fast food joint in Bangalore. It was formed by partnership of three friends. So please observe that word. It was formed by partnership of three friends, Ajay, Biren, and Chand. Ajay and Biren are working partners, while Chand is a non-working partner. And we know that as per income tax law, we can pay salary only to a working partner. And that too, for that salary, we have got some limits which are given by section 40B, my dear friends. 40B clearly says, compute something known as book profit. Based on book profit, you please do the working. And based on book profit, how do you do the working? On first 3 lakhs, 1,50,000 or 90%, whichever is higher. And on the balance, will calculate 60%. Friends, I'm sure we know that point, everybody. Come on, please see that. For the year 23-24, Fresh Foods reported a net profit of 30 lakh rupees before the following deduction. Salary of 50,000 each per month payable to Ajay and Biren, and salary of 10,000 per month payable to Chand. But salary to Chand is not allowed as per income tax because he is not a working partner. And these payments have been authorized by the partnership deed. Depreciation on plant commission section 32 is 5 lakh rupees and it is computed. Section 32 means it is as per income tax provisions. Interest on capital at 15% per annum on the capital of Ajay, Biren and Chand, on which interest is to be calculated. That means interest is not reduced so far. If it is not reduced so far, to calculate book profit, we'll reduce that interest. Next. A general survey published in a food trade magazine highlighted people's perception about the food served by food joints across the city. So this is all the story related to other than taxation. Market size, how do we reach the market, how do we run the operations. It's all related to business strategy. Everybody is giving their opinions. Then post that, COVID pandemic, kitchen infrastructure. So the moment you read one line, you should be able to identify very, very easily, my dear friends. Whether it's related to tax or not, you'll be able to identify. That's it. If you see the all story is other than taxation, my dear friends. Come on, say no. Which of the following statement is true regarding keyman insurance policy? Number one, any sum received under a keyman insurance policy is taxable in the hands of Fresh Fruit. In fact, that is correct. No doubt about it. Next. Insurance paid under a keyman insurance policy pertaining to life of partners is a deductible expenditure. That is also true, my dear friends. No doubt about it. Bonus received under a keyman insurance policy is taxable in the hands of Fresh Foods. That is also correct. In fact, all the three statements are correct. Let me see the options. 1 and 3, 1 and 2, 1, 2, 3. So answer is very clearly option C, my dear friends, 1, 2 and 3, because all the 3 points related to keyman insurance policy are correct statement, my dear friends. Whenever we pay premium, we'll take the deduction, and when maturity amount comes along with bonus, that will definitely become taxable. There is no doubt about it. Are we getting clarity on this point? Good. Next. Then this is about audit. Then is about product pricing and strategy. Then is about value added activity. Then critical success factors. It's not related to tax at all. Then finally, sixth question, descriptive. Calculate book profit of the partnership firm. That will definitely do. For the purpose of calculation of allowable deduction for salary. We'll do that. And what is the allowable deduction for salary? And next point is anyways not related to tax. That is related to performance management. and about strategies. So let me do the working, my dear friends. Come on. Case study number 25. Descriptive question number 6. As per section 40B, remuneration to partners in excess of limit shall be disallowed. Then limit is based on book profit. Limit is based on what, my difference? Book profit. On first 3 lakhs, it is 1.5 lakh or 90%, whichever is higher. And finally, on balance, it is 60%. In our case, let me compute what is the book profit. Net profit as per P&L account. Come on, friends, what is the net profit they gave us per P&L account? Net profit, what they gave us per P&L account is 30 lakh rupees. Net profit as a P&L account is 30 lakhs. Less, come on, depreciation as per income tax, which is nothing but 5 lakhs. And I'll also reduce interest on capital to the extent of 12%. And what is the capital they have put? Capital, what they put in the question is, in the question, they gave a capital figure of 10 lakhs, 10 lakhs and 50 lakhs. Am I right? Let me check. In the question, the capital figure given is, in the question, the capital figure, what they gave is 10, 10 and 50 lakhs. 10, 10 and 50 lakhs means 70 lakhs. 70 lakhs into 12%, which comes to 8 lakhs 40,000. So finally, my dear friends, my book profit figure works out to 30 lakhs minus 5 lakh minus 8 lakh 40,000, which comes to 16 lakh 3,000, 16 lakh 60,000. Are we getting clarity, my dear friends? Come on, please speak out. Then limit as per section 40B. What is the limit, my dear friends? On first 3 lakhs, it is 1.5 lakhs or 90%, whichever is higher. So this comes to 2,70,000. On balance at 60%. Balance figure means 13,60,000 into 60%. So the limit as per section 40B is equal to how much, my dear friends? Come on. It is 10,86,000. That is the limit as per section 40B. I hope we are getting clarity, my dear friends. Come on, please reply. Come on, friends, please reply. Now, as per section 40B, salary paid to working partner is only allowed as deduction, subject to limit above. So that is the story of this very, very interesting question. And the question, my dear friends, in fact, they gave a salary of 50,000 per month to Ajay and Biren. That means 50 plus 50 is 1 lakh. 1 lakh into 12 is 12 lakhs. 12 lakhs they paid. And of course, 10,000 they paid to Chand as well, which is again 1,20,000. Total salary what they paid is 13,20,000. Even though they paid 13,20,000, my dear friends, the deduction what they'll get is only 10,86,000. So that is an interesting concept which is to be noted in this brilliant question. And this has got a concept very clearly about 40B. So it is important that when you see a case study, you should be able to identify what is that they are trying to talk about. Are we getting clarity, everybody? Exactly. So that's the end of story of this interesting case study. Now let me open the next case study as well, my dear friends. Come on, please cooperate. So what we have just completed is about 25 case study, fresh foods. Let me connect to the next case study, guys. Just a second, let me open that. Yeah, I'll share the screen. Got it. Come on, please see the next case study, guys. Case study number 26. In the bustling heart of Kolkata, West Bengal lies Money Troop 3 Limited, MTL, an unlisted public company established in 1994. They have carved a name for themselves as a distinct manufacturer and retailer of diverse selection of coffee and tea powders, catering to discerning clientele across India. Very good. MTL takes immense pride in the state-of-art processing and packaging facility. They source finest coffee beans, tea leaves. Okay, very good. Maybe in this case, they can ask one question related to tea, coffee, rubber, agricultural income rule 7A, 7B. Correct? Next. Tea and coffee market. This is all the story as to how they are getting their business done. So this is all the strategy story. Next. On July 1st, MTL imported a consignment of coffee beans from Brazil through establishing a contact with such coffee bean supplier situated in Brazil and negotiating the price agreement, including price, quality specification, and delivery terms. Both parties prepared necessary documents such as commercial invoice, packing list, bill of lading, and certificate of origin. MTL has a customs broker, Mr. Deval Kali, to handle clearance process in India, ensuring compliance with import regulations and duty. Very good. That's how practically we take assistance of customs broker for clearance process. The bill of entry for warehousing of goods was presented on 5th of July and the goods were duly warehoused. So on 5th of July, bill of entry for warehousing is filed. The goods were subject to duty at 50% ad valorem. In the meanwhile, on 1st of August, exemption notification was issued, reducing the effective customs duty at 30% ad valorem. Mr. Deval, on behalf of MTL, filed bill of entry for home consumption on 1st September, claiming duty at 30% ad valorem. However, Customs Department charged 50% ad valorem being the rate of duty on clearance into warehouse. Is it correct, my dear friends? Definitely the answer is no. Why, my dear friends? Come on, tell the answer. In case of duty rate, we always see the date on which bill of entry for home consumption is filed or the landing of the vehicle, whichever is later. When we talk about exchange rate, we always see on the date of filing bill of entry. It could always be bill of entry for warehousing or home consumption. Warehousing also possible. But when we talk about duty rate, we always see on the date of filing bill of entry for home consumption. So in this particular scenario, there is no question of charging 50% duty. What they have to charge is 30% only, my dear friends. Further, cost of insurance was not ascertained from the document submitted before customs authorities by Deval on behalf of MTL. If insurance is not ascertainable, we'll take 1.125% of FOB. We learned this concept in valuation, my dear friends. Rule 3, read with Rule 10, adjustments to transaction value. Relevant for determining CIF price of imported goods, which is obtained by making certain additions to value of imported goods. MTL is an India's compliant company. Okay. Then it's all about XBRL. Fine. Upfront. Good. See this point. On analysis of third year statement of profit and loss account, they issued debentures which were matured at the end of 5 years. Debenture holder was given an option of upfront payment of 50 per debenture on account of interest, which was to be paid immediately by the company. As per the option exercised by debenture holders, company paid interest upfront to them in the first year itself, and the same was claimed as deduction. So if you observe carefully, interest was paid upfront to the debenture holder, and the entire interest was claimed as what, my dear friends? Deduction. So this is what they have done as per taxation laws. You're getting my point, everybody. So please, come on. It's an interesting case, my dear friends. I hope we are getting clarity, all of us. Come on, please don't relax. Please concentrate. Please focus. My humble request to all of you to please not to relax. When we're discussing some case study, kindly please concentrate. Are we all clear with this? Can I proceed? Come on, please don't maintain that pin drop silence. Next. But in the accounts, the interest was shown as deferred expenditure to be written off over a period of 5 years. During the course of assessment, AO spread the upfront interest paid over a period of 5 years term of debentures and allowed only 1/5 of amount in the previous year. And the order was issued on 20th May. Okay. They are the auditors. Audit report is given. Okay. These are related to audit. Done. Let's see the multiple choice question. First one. In case of MTL, the amount of cost of insurance will be determined as what? Come on, friends. What is the cost of insurance? The insurance is straight away 1.125% of FOB. Correct or not, my dear friends? But next one is where FOB is not ascertainable, but the sum of FOB plus cost of transport is available, then we'll take 1.15% of such sum. This statement is also correct. Second also is correct. Third is also correct. Let's see the options. 1 or 3, 1 or 4, 2 and 3, 2 or 3, or 2 and 4, 2 or 4. The answer is very clearly 2 or 3, my dear friends. Option C, my dear friends. Then next point is about Ind AS. The third one is about Ind AS again. Fourth one is about XBRL. Fifth one is about strategies. Then explain the rate of duty applicable for home consumption. I already told you the answer that the rate of duty what will apply is very clearly 30% because the rate of duty will be considered on the date of filing bill of entry for home consumption and not on the date of filing bill of entry for warehousing. According to the duty rate that will be considered will be 30% only, my dear friends. And this concept is actually given by Section 15 of Customs Act. Then, whether the rate of exchange on 1st August could be adopted for the purpose of conversion of foreign currency into local currency. Answer is no, my dear friends. Answer is no, my dear friends. The reason is very clearly, my dear friends, in case of exchange rate, the concept is given by Section 14, which clearly says exchange rate will be considered on the date of filing. Exchange rate will always be considered on the date of filing bill of entry. That much only law told. And the bill of entry could be the bill of entry for warehousing or bill of entry for home consumption. But it is nothing but first bill of entry. The day when we file bill of entry, what is the exchange rate? That will be considered. So we'll see the exchange rate on date of filing bill of entry for warehousing, which is nothing but 5th of July. Next point. Briefly explain the chief reasons on the basis of which PO can raise doubts on the truth or accuracy of the declared value. This you would have already learned, my dear friends, in Rule 12 of Valuation Rule, rejection by proper officer. When do they reject the transaction value? They generally reject when identical goods or similar goods are imported at higher price, or in this case, there is an abnormal discount, or there is improper classification of good, or there is no declaration of the brand, grade, and all, or there is some manipulated documents which are submitted. There is always the possibility like special discount given to some agents. So in all these circumstances, my dear friends, very clearly the proper officer has a right to reject the value. But he need to substantiate why he has rejected that value. That is very important. So that's the story of this very, very interesting case study, guys. I'm sure this case study, what we discussed, makes a lot of sense for everyone, my dear friends. Come on, friends, please reply yes or no. Very good. Can I proceed to the next interesting case study? Yeah, let me check once. Hold on. Okay, that's it, my dear friends. The balance case studies will take in next session. No problem. We still have 2-3 more interesting case study. We'll cover that case studies in the next session. Thank you so much. Take care. Shivateja signing off. Any doubts, anytime, feel free to get back. Our forums is always there for you. Any doubts, feel free to ask. We'll be more than happy to answer your queries, my dear friends. Thank you so much. Take care. Bye-bye. Hello, my dear students. Welcome back to discussion about some more interesting case studies in IBS. And we have got some interesting case studies to talk in this particular session, where we'll talk about some interesting points related to direct and indirect tax laws. So let me share the screen and start opening the case study, my dear friends. Come on. Yes. I'm sure the screen is visible for all of you. Perfect, my dear friends. Perfect. Come on. So without any delay, let me start the discussion. Let's look at case study number 28. BL Limited is a biotechnology and pharmaceutical company that listed on National Stock Exchange. It's a biotechnology and pharmaceutical company. First of all, we need to understand what are all the areas which are relevant from a taxation perspective than this case study. That's what I'm going to talk about it, because I'm going to talk specifically from direct and indirect taxation perspective. Please see that. It's a small cap company engaged in research and development, manufacturing and marketing of pharmaceutical formulations and vaccines in India. It has a factory in Gujarat. Very good. Company commenced business and all its data is given. Growth has been steady, profitable, okay. And the financials of BL Limited are being given. 23, 24, 22, 23. The details are given. Debt equity ratio, tax structure, everything is given. And the company is keen on increasing the company's potential to generate sustaining business. Hence, it felt the need to measure performance so that periodic assessments can be made. Management wants to adopt the balanced scorecard framework. Okay. Improve EPS, enter new markets, production capacity. Okay. CA Series has been appointed as an auditor. This is the first year of audit that CA Series should be performing for BL Limited. And in the financial statement as of March, BL Limited has inventories that are material. And attending the physical count. Okay, that's related to audit. Then, next point. It has an in-house research and development facility. Friends, what is that line given? It has an in-house research and development facility. So we're clearly talking about R&D expenditure. And the moment we talk about R&D expenditure, which section comes into play under income taxes? Section 35 of PGBP comes into play. And section 35 clearly says whatever expenditure is incurred towards scientific research, that can be claimed as deduction. And moreover, if the company is engaged in manufacturing or in biotechnology, my dear friends, that is specifically covered in section 35 2AB. There also section says you can take deduction for scientific research expenditure. 100% deduction is allowed, except for land and building. Of course, building separate provision is there. There we can take 100% deduction. Come on, look at it. It has in-house research and development facility within the factory premises that has been approved by the prescribed authority. During 23-24, company incurred 5 crores on scientific research, and the details are as under. Revenue expense 1 crore. Can we take deduction? Yes. Capital expenditure, machinery and plant. Can we take deduction? 100% answer is yes, because section 35 gives deduction for both revenue as well as capital expenditure. Then capital expenditure, land 1 crore. If it's expenditure on land, that we can't take it as deduction, because section 35 specifically says scientific research expenditure on land and building is not allowed. But for building, separate provision is there in section 35 that again says 100% deduction is allowed. In net effect, we can't take deduction for land, but other than land, we can take deduction. Next slide. Expenditure on clinical drug trial. Clinical drug trial is also covered in section 35. Whatever expenditure is incurred on clinical drug trial, that is also eligible for deduction under section 35. So if you look at carefully, other than land, rest all can be taken as deduction. So in net effect, 1 crore we can take, 2 crore we can take, there's 2 crore we can take, totally 3 crores. Land we can't take, clinical drug trial 1 crore, totally 4 crores. So this 4 crores can be taken as deduction under section 35. So let's see. Multiple choice questions. First one is not about tax. Second one, what is the amount of deduction that a company can avail for scientific research? Company has not opted for provisions of 115 BAA BAB. That's important, because if company opts for 115 BAA or BAB, they can't take this section 35 deduction. Good. And what is the option? 5 crore, 4 crores, 3 crores, 1 crore. Come on, what is the answer, my dear friends? Very clearly, the answer is 4 crores. Already we discussed the reason why. Because as per section 35, expenditure for scientific research can be claimed as deduction, but we can't take expenditure for land. I hope you are getting clarity. In fact, land and building is not allowed, but for building, there is one separate provision which says building deduction is also allowed. Good. So straight away, my answer is, my dear friends, 4 crores. Third bit is not tax. Fourth bit is not tax. Fifth bit is also not tax. Then descriptive question, there's nothing related to taxation here. It's all about audits. So friends, sometimes you'll find some interesting case study. Some case studies you'll find where there is a lot of element of tax which is there in picture. And some case studies you'll find where there's less amount element of tax. It doesn't mean that less element of tax always symbolizes that tax will come less in examination. And some case studies, if you have seen, where there are a lot of questions related to taxation as such. So there is no generalized principle what you can apply telling that from taxation more case studies will come or from taxation less case studies will come. It all depends. And of course, all set and done, there is a good element of weightage which is given for taxation perspective. Are we all clear, everybody? So can we look at the next interesting case study, guys? Come on, let me open that. Done. I'll share the screen. See that, my dear friends, case study number 30. WDG Limited, incorporated in 1999, is a public unlisted company headquartered in Surat, Gujarat. It has carved a niche for itself in the production of high-quality industrial spare parts, catering to diverse clientele across manufacturing, construction, and allied industry. WDG Limited boasts a state-of-art manufacturing facility equipped with advanced machinery and technology, and their production process adheres to stringent quality control measures. So it is all about what is the story of that WDG Limited. Next. Company is desirous to upgrade its production process since directors believes that technology-led production is the only way the company can remain competitive. On April 1st, company entered into a property lease agreement in order to obtain the tax benefits. However, the financial statement does not show a lease asset or lease liability as on the date. FR, financial reporting, Ind AS. A new financial manager, Karthik Desai, a chartered accountant, joined WDG Limited before the financial year ending 31st March 2024 and was engaged in the review of financial statement to prepare for upcoming audits and to begin making a loan application to finance the new technology. Karthik believes that the lease agreement should be recognized in the balance sheet. Okay. Fine. That's all related to other than taxation. Next is about performance management. Then is about cash flows. Next. Looking at the financial and taxation knowledge of Karthik, Miss Tina, asked a favor from him to calculate the deduction available to her under appropriate provisions of Income Tax Act for assessment year 24-25. Very interesting. Considering the following particulars for the year ending 31st March 24, if she has opted out of default tax regime under 115 BAC, opted out of default tax regime, that's why a lot of deductions under Chapter 6A will come. But if you're paying tax under default tax regime 115 BAC, you can't take any deduction under Chapter 6A except 80 CCD2, 80 CCH2, and 80 JJAA. No other deduction in the Chapter 6A will come. But let us say you shifted out of default tax regime, then all deductions under Chapter 6A will be eligible. Next. Let's see point by point and decide. Life insurance premium paid 20,000 rupees and actual capital of sum of the policy assured is 2,80,000. And the policy was taken on 31st March 2012. If any life insurance policy is taken before 1/4/2012, my dear friends, the maximum deduction is 10%. The maximum deduction, 1/4/2012, right? If it is before 1/4/2012, the maximum deduction for life insurance is 20% of sum assured. 20% of sum assured, 20% of 2,80,000 is 56,000. But actually what I paid is only 20,000. So my deduction, what I'll get is 20,000. Next, contribution to PPF, 30,000 in the name of father. This we can't take deduction because all investments under ATC should be in the name of assessee only, my dear friends. It is other than assessee, then we can't take deduction. Only life insurance we can take if it is for self, spouse, and children, not even parents. Sometimes in exam, they'll try to give life insurance for dependent parents. Even that we can't take deduction. So in the second point, contribution to PPF 30,000 name of father, that is not eligible for deduction. Next point. Tuition fees payment 8,000 each for two sons pursuing full-time graduation course in Surat. And tuition fees for daughter pursuing PhD in Stanford University, USA, 2,50,000. So when I talk about tuition fees, my dear friends, tuition fees for full-time education for two children, that is covered in section 80C, my dear friends. That is specifically covered in section, which section, my dear friends? 80C. And the point to be noted in 80C, my dear friends, is that tuition fee will be allowed as deduction only if it is paid to an education institution in India. But if it is paid to an education institution situated outside India, I repeat once again, if the tuition fees is paid to an educational institution situated outside India, that cannot be taken as deduction. So there's 8,000 each for two sons that we can take deduction. But for PhD in Stanford University, that we can't take it as deduction. Next slide. Housing loan, principal repayment 23,000 to Axis Bank. Properties under construction at Surat as on 31st March 2024. Friends, let me tell you, whenever the property is still under construction, my dear friends, for interest, we apply the concept of section 24B, and there is a story of pre-construction interest. And there is no concept of pre-construction principal under income tax law. Whenever property is under construction, my dear friends, principal repayment of housing loan during the period of construction is not allowed as deduction under section 80C. Very, very important point. I'll repeat once again. Principal repayment of housing loan during the period when the property is under construction, that is not allowed as deduction under section 80C. Very, very important point. Next slide. Principal repayment of housing loan taken from relative 80,000, property self-occupied situated at Surat. Generally, principal repayment of housing loan is allowed as deduction, but in this case, we can't take deduction because 80C clearly says principal repayment of housing loan is allowed as deduction only if the loan is taken from central government, state government, or a bank or specified employer or any institution. But in this case, he has taken from friends and relatives. Then we can't take 80C deduction for repayment of principal amount of housing loan. So if this would have been a case where we are talking about interest, then 24B says, because 24B never told that loan should be taken from central government, state government, bank, employer, and institution. But that language is there in 80C. 80C clearly says principal repayment of housing loan is allowed as deduction only if loan is taken from central government, state government, bank, employer, or any institution. Very, very interesting scenario, guys. Next point. Come on, friends. What is the next point, my dear friends? 5 years time deposit, that is 5 years FD, in an account under post office time deposit scheme, 60,000. This is specifically covered in 80C, my dear friends. We can happily take deduction. 5 years FD. Post office time deposit scheme, definitely deduction is allowed. There is no problem at all if it is 5 years deposit. Next point, my dear friends. Investment in national savings certificate, even that is allowed as deduction under section 80C, my dear friends. Next. Karthik had submitted his income tax details to the company for the purpose of TDS. He is born on 4/10/1990 and has gross total income of 2,50,000 for 24-25, comprising of only salary income. If it is only salary income, only 2,50,000, his total income does not exceed basic exemption limit. If his total income does not exceed basic exemption limit, he is not required for return of income. But see next. He pays electricity bill of 10,000 per month. That means electricity bill is 1,20,000 per annum. Friends, in section 139(1), which talks about due date to file return of income or compulsory filing of return of income, it clearly says that filing of return of income is mandatory if total income exceeds basic exemption limit before deduction under Chapter 6A, before exemption under capital gain. However, there is some special point which is to be noted in section 139(1), which clearly says that in case where you are paying electricity bill of more than 1 lakh, or you are depositing more than 1 crore in current account, or you are incurring more than 2 lakh rupees for travel to foreign country. In any of these cases, my dear friends, filing of return of income is mandatory irrespective of your total income. In this case, electricity bill is more than 1 lakh per annum. So filing of return of income becomes mandatory irrespective of income. Next. He made a visit to Melbourne along with his wife, for which he incurred to and fro flight charges of 1.1 lakh. So he's not crossing 2 lakhs, but still electricity bill is crossing more than 1 lakh. Remaining expenditure for visa, stay, sightseeing amount to 90,000 was met by his brother residing at residence. Next point. MCQs. First one is not tax. See the second one, that's about board of directors. Third one is net present value. Fourth one, net present value. Fifth one, whether Karthik is required to file return of income for AY 24-25. 101% answer is yes. The answer is yes because the option is option C. The reason because Karthik is required for return of income because he is paying electricity bill of more than 1 lakh per annum. Since electricity bill is more than 1 lakh per annum, he is mandatorily required to file return of income. Very, very interesting point. Makes a lot of sense. Section 139(1). High possibility that this kind of question can come in IBS. Next, descriptive. Potential conflicts done. Deduction available to Tina. Internal capabilities that's not related to taxation. Deduction available to Tina. Already I discussed that with you, but let me put it in words. That is question number 7. Yeah. Let me open my Excel, guys. Yeah. Let me share the Excel. Case study number 30. Question number 7. Computation of deduction available in case of other than default tax regime, or I'll write it as out of default tax regime. Clear now, my dear friends? Because if it's default tax regime, we cannot take all these deductions, guys. I'm sure we are getting complete clarity on this point, my dear friends. Very, very interesting situation and very, very interesting point. Come on. First one, life insurance premium. Deduction is maximum 20% of sum assured. But what I paid is less than 20% of sum assured. So I can happily take entire deduction, my dear friends. Then contribution to PPF in the name of father. This is not allowed. Not allowed because it should be in the name of assessee only. Next. Tuition fee for 2 sons. Tuition fee for what, my dear friends? 2 sons. I will take it as, but I'll write one line here. Tuition fee outside India is not allowed. In India, how much we paid? 8,000 per son into 2, which comes to 16,000, my dear friends. Next. Housing loan. Principal repayment. Not allowed when property is under construction. So this figure will become 0, my dear friends. Next line. Again, same story. Housing loan. Principal repayment. Not allowed when loan is taken from relatives. Because ATC clearly says deduction will come only in case where loan is taken from any bank or financial institution or specified employer. Getting the point, my dear friends? Or any government. Next. Post office 5-year time deposit. That I can happily take deduction. How much is the deduction, my dear friends? 60,000. Next. Investment in National Savings Certificate. That is also 60,000. So total amount, my dear friends, 1,56,000. But the maximum deduction, what I can claim under section 80C is only 1,50,000. So that's the story of this very, very interesting question, my dear friends. I'm sure this is clear for all of you guys. Everyone, come on, please reply. Very good. So without any delay, let me proceed to the next interesting case study, my dear friends. Hold on, let me open that. Yeah, done, got it. So let me share the screen, my dear friends. One more very interesting case study. Please see that. I'm sure the screen is visible for you guys. Yeah, thank you very much. Case study number 35. Wanton Terun Limited is a fast-growing listed company focusing on innovation in the textile and garments industry. Company has grown in last 1 decade from Punjab to the homes of millions of customers across 50 countries and is aiming to target of becoming the most trusted brand that takes conscious care of customers, employees, and all stakeholders and treats them the best. Company also has 5 subsidiaries operating outside India. Okay. After gaining experience as CFO of the company, WTL for the last 15 years, Thiru has resigned and started his own venture. Okay. Then management of the company decided to have interview board for selecting the candidate of CFO. Okay. See the first point. A company is operating in 50 countries. So employees of the company travel worldwide to oversee the operations and for business expansion. For this purpose, foreign currency is taken from authorized dealer who charge GST as per relevant provisions of GST law and used for meeting all overseas expenses, including stay, local traveling, food expenses. Okay. For upcoming business trip, employees will be traveling to USA and require $10,000. Company purchased 9,900 USD by paying 7.40 lakhs. However, customs exchange rate and bank buying rate on the same day will lead to 7.45 lakhs and 7.5 lakhs respectively for equivalent number of dollars on same date. So basically they are talking about GST valuation rule, my dear friends. That too we are talking about valuation rule, which is given by Rule 32. Rule 32, my dear friends. But if you see very, very clearly, they gave only customs exchange rate and they gave bank buying rate, but they have not given the RBI rate as such. And if RBI rate is not available, value of supply section 32, value of supply rule 32 clearly says value of supply will be 1% of currency exchanged. Next. During the last overseas visit of senior vice president, company received export order for specified type of garments for which yarn was required to be imported. Company imported special yarn from Germany for manufacture of garments. There was no transaction value available for such yarn. Consequently, transaction of identical goods under customs was considered very good, no problem. As long as they are at same commercial level, substantially same quantity, then very much that can be considered. Next. One of the overseas subsidiary of Triple Inc. has provided financial assistance to WTL. That means the loan is taken from associated enterprise. A debt is taken. And the said assistance is outstanding in the books of accounts of the company as foreign currency loan, on which it paid interest of 32 crores. Even though they are paying interest of 32 crores, we have got an interesting section in income tax section 94B, which clearly says maximum interest what you can pay is only 30% of EBITDA or actual interest. That much only you can pay. Next, 32 crores. The amount of TDS will be deducted and deposited within the due date. EBITDA, that is profit before interest, tax, depreciation, and amortization, is 100 crores. 100 crores, 30% is 30 crore. So 2 crores is the excess interest that is being paid. Next. Company has to comply with listing obligation and disclosure requirements related to corporate governance. And for this, an independent and qualified audit committee is already formed and functioning. The audit committee consisted of 6 directors having wide experience in corporate matters, with 4 of them being independent directors. One of the directors has resigned as director of the company, and WTL proposed to appoint Q as independent director, who is already serving as MD in one company, and independent director in 3 other listed entities. Next. Woman director, due to her engagement, other engagements, she tendered resignation. Okay. Then share-based payments. That's about your FR. Done. In respect of purchase of foreign currency from authorized dealer, whether GST will be applicable? Of course, answer is yes. What will be value of services on which GST will be chargeable under 32(2)(a)? Already I told you, my dear friends, value of supply will be 1% of currency exchange. That is 1% of 7,40,000, which comes to 7,400. And 18% on 7,400 will be 1,332. So the answer is option B, my dear friends. 1% of 7,40,000 comes to 7,400 and 18% of 7,400 is 1,332. Next slide. Second bit. With respect to facts given in issue 2 above, interest to be reported by tax auditor under form 3CD. Very good question. In fact, my dear friends, in 3CD, there is one reporting that is being required in clause 30B with respect to section 94B, my dear friends. And what we are required to report is the actual interest that is being paid and the excess interest that is being paid. So what we will report is 32 crores and also 2 crores. So again, the answer is option B, my dear friends. Are we getting clarity on this point, everybody? Very, very interesting situation. It's clearly about the tax audit form, what they are asking. Friends, I hope we are getting clarity on this point, everyone. In Form 30, we are just looking at it. They're asking first question, whether assessee has incurred expenditure during previous year by way of interest? If yes, what is the amount of expenditure incurred? And they're also asking, what is the amount which is in excess of 30% of EBITDA? Both they are asking. So we have to report 32 crores also and also 2 crores also. Let me share the screen, guys, once again. Come on, look at that. Whether assessee has incurred expenditure during previous year. If yes, what is the amount of expenditure incurred? They're asking then what is EBITDA? What is the amount which is in excess of 30% of EBITDA? So that is how they're asking the details, my dear friends. So that is why for this particular question, the answer is 32 crores and 2 crores, which is nothing but option B, my dear friends. Next point. Company secretary, that's not tax. Women director. Which of the following statement is correct in relation to import of yarn for which identical goods was considered? Transaction of identical goods and sale at any commercial level? No. Sale at same commercial and any quantity? No. At same commercial level and substantially same quantity. So the answer is option C, my dear friends, because we always consider sale at same commercial level and substantially same quantity. In fact, this point is given by Rule 4 of Customs Valuation Rules. An interesting provision for discussion. Next. Descriptive questions. First one. Second one is not your tax. First one, Mr. Q, before accepting the appointment as auditor, discuss with the company about implication of GST on his appointment and emoluments. Explain if the services provided by directors are under ambit of GST law. We clearly know that services by employee to employer in the course of employment is neither regarded as supply of goods nor regarded as supply of services, as per Schedule 3, my dear friends. But if the director is not an employee, who is an independent director, then that will definitely become taxable. And in this particular question, they have specified that Q is going to be an independent director. When Q is going to be independent director, that service given by independent director to the company will definitely be taxable under a GST law. And moreover, the important point to be noted is that it will be taxable under reverse charge mechanism, because services by director to body corporate is covered under RCM. So that's the story of this interesting case studies from my end, my dear friends. We'll again come back with some more interesting case study the moment ICA adds more case studies to our syllabus, my dear friends. Okay. Thank you so very much. Wish you all success. Stay tuned for more updates, and any doubts, feel free to get back to us. I've been telling this again and again that any doubts, please feel free to get back. Don't hesitate. We are there for your support. Your success is our success. Thank you very much. Take care. All the best. Shiva Tejas signing off. Your tax guru signing off. Thank you very much.